for Bitcoin, there isn't a whole lot you can do with it. You can send money around and you can hold it as a store of value, but it doesn't really let you do much in finance itself. And so I think when you see products like Ethereum come out that enable you to use these things called smart contracts, where you can send money to a computer program and remove the lawyers in the middle, then I think that's where we actually started to see this huge flourishing of people starting to build new projects.
I just think of their assets, their opportunities to invest. I don't think the typical investor needs to worry whether they are securities or not securities.
If there's not a market for what you want to trade on, you can actually create a market for that, which I think is actually the most powerful piece. Because up until this point, that's not really been feasible.
Our fund has returned 140x, so it is possible. And that's why I think investors should put a few percent of their portfolio in crypto. Could go to zero maybe, but it's very asymmetric risk reward.
Mike Green for Real Vision. I'm excited to sit down with two of my favorite people in the Bitcoin space, Joey Krug and Dan Morehead of Pantera Capital. Joey is a brilliant young investor focused in the Bitcoin space. He's going to tell us some exciting news about that. And Dan brings an incredible experience with Bitcoin and the general cryptocurrency environment. I'm really interested to hear how things are developing for the two of them. Mike Green, I'm here in San Francisco, and I get to spend time again with Joey Krug and Dan Morehead. Two guys who are as deep in the crypto space as just about anybody on the planet. And I wanted to catch up and see what you guys are thinking about these days. Dan, your firm Pantera Capital is one of the first to launch a crypto-oriented fund. In particular, you were focused on the store of value dynamic, speculating, not to use the word in a pejorative sense, but speculating on the appreciation in crypto coins. You launched in 2013?
Yep.
So obviously spectacularly successful. It's been an extraordinary investment, and your returns have far outpaced what has been seen from the individual coins. A lot has changed in the world since we last talked last fall in terms of prices appreciating sharply and then having corrected. What do you think happens next? Where are you in the crypto as a store of value dynamic?
I think that's an important question. Back in the day, there was just Bitcoin, no other currencies, not really any equities you can invest in. Now there's 1,500 projects you could invest in, plus maybe 500 different equities that you could buy. And so I think a sensible approach for a investment is not just buy one thing, because that's not the way you would trade stocks. You'd buy a basket of things. And I think people should avoid the temptation to worry about, is it Bitcoin that's going to win? Is it Ethereum that's going to win? Or is it Bitcoin Cash or Ripple? And get a sensible portfolio of assets, whether it's cryptocurrencies, pre-auction ICOs, or venture investments.
So when you answer in that way, you're thinking of these as securities at this point. I mean, it is a collection of assets, some of which have coin or currency-like characteristics, some of which are purely equities, some of which may be dividend-paying entities in terms of capturing usage fees, et cetera. But you think we're at that point now where it becomes a securities market as compared to a...
Well, securities is a very loaded word. It has very legal definition in certain countries. I would say that most of the ICOs that we've invested in are valuable only because of their utility, and they're very far from the definition of a security. I just think of their assets, their opportunities to invest. I don't think the typical investor needs to worry whether they are securities or not securities.
And so at this point, though, the idea of, is Bitcoin going to $1 million or is Bitcoin going to $0? It sounds like your answer to that is, I don't think it matters, right? I mean, that's one component of 1,500 different possible permutations that you could explore. You see it as a series of option-like bets within a broader portfolio.
Yeah, I think that's the right way to look at it. In my 30 years of investing, this is by far the most asymmetric trade I've ever seen. Obviously, you could lose substantially all, maybe even 1x your money, but you could make 50x or 100x on many of these trades. And it sounds ludicrous in the normal securities market to say those kinds of things, but our fund has returned 140x, so it is possible. And that's why I think investors should put a few percent of their portfolio in crypto. Could go to zero maybe, but it's very asymmetric risk reward.
So I've spoken with others about this idea that crypto is that is thought of as an asset class that people associate with gold, et cetera, or people have labeled it, a .com type dynamic. It feels to me, and some are out there saying, this is only 1994 in the internet analogy, et cetera. It almost feels to me like this is so much earlier, right? That we're still, I was speaking with somebody else about the idea that this is maybe 1982, right? People are still gluing stuff together in their garage in a lot of ways, and there's an incredible amount of experimentation. Where would you draw the analogy if you're thinking about it?
I'm glad you said that, because very few people go before 1992 when they do their internet analog. And if you think about it, DARPANET was around from the 70s, and only 1% of the world used it in 1992. They created a browser, made it easy for the rest of us, and it exploded into use, right? And I think that's the way Bitcoin is right now. There's a couple percent of the world who use it, so it is potentially the 80s internet rather than the, is it 95 versus 99 argument. And again, I had a fascinating debate on CNN with an academic who's a very rare breed of an animal, a super negative academic on Bitcoin, and had written a paper, RIP Bitcoin, it's time to move on, it's failed, it's pets.com. And the story there is, the article was written when it was at $400, and now it's at 9,000. So you're really missing this massive asymmetry in the leverage. And then again, to call it pets.com is really forgetting who was the majority investor in pets.com. It was a guy who saw a very disruptive technology, wanted to invest in a lot of different ways to use this disruptive technology. One was selling pet food on the internet, it didn't work. The other one was selling books on the internet, it worked. And so that's what people should view Bitcoin, Ethereum, XRP. Not all of them are probably going to work, but if you have a portfolio of them and it's as disruptive as we believe, the portfolio would do quite well.
Well, I think we can actually name that individual, right? Jeff Bezos, and not the founder of Barnes and Noble. But it's so I agree with that people need to think about it from a portfolio perspective. There is this interesting question about, we've been doing it, and the analogy in terms of time horizon also helps to address what people are pushing back on, right? One of the rallying cries for those who are super bearish crypto assets is, we're 10 years in and there's not a use case yet, right? Well, as somebody who grew up in Silicon Valley, there was no use case for the time that I spent banging away on a Trash 80, right? It was total waste of my time, as my father was very happy to remind me. But it ultimately grew into something that was totally unrelated, and Radio Shack is now bankrupt under Tandy Corp, as it was back then. But it's something that we use every single day. And again, crypto seems difficult to look at and think that it's not going to be a feature of the universe, whether it's Bitcoin or Bitcoin Cash or smart contracts in the form of Ethereum. These all seem like things that are absolutely destined to happen.
Yeah, part of that is the misunderstanding of how the protocol and the application are going to derive value in the post-internet world. So in the current internet, it's the protocols that have no value and it's applications that suck money out of their customers somehow on top of it that get all the value. So everyone's saying, hey, there's no killer app of Bitcoin. They missed the point that Bitcoin's the killer app of Bitcoin. There's hundreds of thousands of transactions happening every day, moving billions of dollars around the world using it as the application layer. You don't need to pay somebody else to, you don't need some rent-seeking, company on top of that. So there will be really cool things built on top of all these blockchains, but the protocols themselves are very valuable.
Well, that's an area where I have a slightly different take, right? Which is that the use case of Bitcoin, I agree with you, is Bitcoin. It happened to arrive at a time period in which criminal enterprises in Russia and China needed mechanisms for getting money abroad very easily. So I'm very skeptical of that dynamic, but I agree with you that there are absolutely use cases in the form of it is used for money laundering, for example. And that's certainly not the only thing that it's used for, but it's a primary use. But it opens up so much else, right? And I know you disagree with me, and feel free to push back.
Instinctual response is, oh, it's so great for crimes. And hey, maybe years ago it was pretty anonymous and it was okay for crimes, but its features, prominent features, every 10 minutes, a ledger of every trade that's ever happened is published with a permanent paper trail of every step in that 10-minute process. That's a really bad feature for committing crimes. all of your transactions are there. And it's very well known that the Silk Road guy used Bitcoin, right? Very few people know that there were 2 federal agents that went rogue and were extorting money from the Silk Road guy, independent of each other, in the same task force, stealing money from other people on the internet, doing all kinds of bad things. They wired $1 million through 5 major banks in the US and 1 mutual fund company, none of whom filed a suspicious activity report. When you have a federal worker paying his mortgage off in one pay check, writing $30,000 checks to cash, that's suspicious, right? And it was 2 peer-to-peer companies, Venmo and Bitstamp, that reported both of these people to the authorities. And I'm actually on the board of Bitstamp, and they were telling me this. There's a federal agent laundering money on their site. And I'm like, you guys have watched way too many Tom Cruise movies. There's no chance that's actually happening. And I looked at this stuff, and I was like, oh, crap, we got to report this. So we reported it to another federal agent. That guy resigned that day, and we're like, oh, no, that's a problem. So both of those people were rogue. And the deal is, when the prosecutor, Katie Hunt, dropped the whole list of all their crimes from the blockchain on their desk, they had to sign guilty pleas. Like there's no way to even remotely even go to trial because you have a list of all the crimes. So I think law enforcement already knows that Bitcoin's terrible for crimes.
So I'm not disputing any of that, and the interesting dynamic as I would articulate what I've seen on the Bitcoin front from China in particular. Is that it is a misuse of subsidized electricity in China in the process of mining to create that. But that's not my focus, actually. It's just it's an interesting dynamic on Bitcoin itself, which has captured people's attention because the price has risen so spectacularly, fallen, and now the debate is what happens next, right? That is totally separate from the crypto universe. And one of the first people that I talked to that I thought was so fascinating, this was actually Joey, right? And it was really interesting listening to somebody who is much younger than either of us, right? Who has had an immediate impact in this space. And so that's the other area that you've been very focused on, is making the investments in either the picks and shovels or the individuals that have a tremendous amount of capability and talent within this type of developing industry. Joey, you started Augur out of your dorm room, right?
I left college, dropped out, and then we started it in LA.
And last time we talked, I told you how proud your grandmother must have been of you for what you've managed to accomplish in this. But from that point, not only have you continued to work on Augur, but you also have been managing with Dan a fund that thinks about crypto from a value standpoint, effectively, or from an investment standpoint, which is one of the complaints that a lot of people have. How do you value these things? How do you think about how do you think about that? And what have you been doing?
Yeah, so the way I think about it is, we have on the fund side, on the trading side, we really have 2 main strategies. One is for investing into new cryptocurrencies. And there, I think the way we approach valuing them is, do they actually need to be a new currency or new token? Do they need to have a separate token? Do the economics make sense? Does it actually benefit from using this tech? And then after passing those filters, which is kind of specific to this investment, then we look at all the regular stuff you look at with any investment, like product, team, market, things like that. On the other fund, which is more quantitative, the sort of stuff we're looking at there are more kind of like little individual things that you can basically use to form a quant model. So things like sentiment data, what's the sentiment around these currencies? Things like how many transactions are flowing through a given chain at any point in time, transaction flows across the blockchains themselves, as well as other kind of more obscure things.
So, and Mike, on that point, I would say I was just in New York and I was meeting with some Tiger Cup friends that are on the equity side, and they're all like, "Hey, we don't touch cryptocurrencies because there's no cash flows to discount. We have no idea how to value it." And I think there's the one time I would go with the cryptocurrency analog. Is it's like the fiat currency market where there are no cash flows to dollar yen. You have to figure out what factors drive it, like current account and interest rates or whatever, and use that to say, hey, this currency's cheap, that one's rich. It's the same with cryptocurrencies. Transactions per second, how many fees are being paid, all those types of data will give you a sense of which ones are cheap and which ones are rich.
So that's interesting because I actually think about fiat currencies as equities. Right? They're effectively the equity of the country, right? Or the debt of a truly sovereign entity, of which there are very few who can really be thought of as the debt of the country, right? So are they taking the money and spending it appropriately, investing in human capital and improving the underlying conditions under which business can be done or profits can be generated. This is really similar. I mean, you're thinking about it in the same way, right? You're saying, what's the infrastructure, and who are the participants, and what's the respect for property rights, and does it create something new and compelling, right? Does it mean something? Does northern Japan and southern Japan, would those be two viable countries? No, there's Japan, right? And so that's you're approaching it from a very quantitative and securities analysis type framework, right?
Yeah, I think the way we think about it is, we've kind of drawn from both stuff that you can analyze sort of any assets, like we looked at, ways to analyze commodities, securities, currencies, and then there's some stuff as well that's specific to this asset class. But the thing I think about quantitative analysis is a lot of the same sorts of things work across multiple asset classes. And I think there's no reason to believe, and empirically we've seen that they seem to work in crypto as well.
So that would play to the idea that these are similar to equities, at least in terms of how you should be thinking about them. And obviously quantitative tools and techniques work across assets, but there is this underlying dynamic of being able to evaluate.
Yeah, I think the one big difference is, as Dan said, most equities, you can attach a cash flow to them. And so when you look at an equity, there's all this sort of stuff you can get from the balance sheet. And here, there's not really any balance sheet. So, it does make them more challenging to, value than any given equity, in my opinion. That also makes it a lot more fun and challenging as well, I think.
Well, I love that you use the word fun, right? Because that's part of the search for alpha is effectively what should be happening. A lot of guys I know are not having fun in the regular securities market. So
that's because there's like 10 million people all staring at the same things, and they're getting tiny little crumbs that they're picking up. And I was just talking at a quantitative hedge fund conference, and I was thinking back, when I started trading CMOs in the 80s, people were managing the book once a week to market on a yellow pad with a pencil. So huge opportunities, but now there's so many people applying so much capital to the normal securities markets, the opportunities are tiny. We're trying to apply, state-of-the-art techniques to a very primordial market. The cryptocurrency markets have enormous amounts of alpha opportunity.
Okay, so you mentioned this idea that it's challenging and more fun, but there aren't traditional balance sheets, et cetera. I mean, I would challenge that a little bit, right? Because a balance sheet is just a measure, particularly the structure of a balance sheet. It's just a measure of the staying power, right? And so it's obviously compared, it's a stock versus flow dynamic as you think about the income statement of the cash flows. But you're effectively saying, how committed are they to this? What's the tenor of the optionality that I have? You have something very similar within the crypto space, which is how much cash do they have and how committed are the developers to this project? I mean, it seems like you're thinking in very similar terms.
So that I would half agree, half disagree there. Okay. So there's some stuff where that's definitely true, especially on the kind of ICO side where we're investing in these projects very early on. On the flip side, though, there's a lot of assets that the quant fund trades where there is no actual, formal company behind it providing developers for it. They're actually just much more organic, community-driven projects. And so for those ones, you don't really have, there literally is no real balance sheet backing it. It's just, but there are things you can look at, right? You can look at how many developers are contributing to it, how much is getting merged into the code base, how many improvements are happening, stuff like that. So you have data. It's just sometimes different, right? Like if you're looking at a public company, for the most part, it's unheard of to look at their GitHub when valuing the equity, right? But here it's actually fairly relevant.
So again, the analogy goes back to the 1980s. If you I don't think you'd been conceived at that point, but there were a series of things called BBSs, right? Which I'm sure you're familiar with the term BBS, but it's bulletin board and with the early chat boards, et cetera. There's a group called the Well that ultimately provided much of the underpinnings of what became CompuServe, right? So a real company grew primordially out of this community type dynamic that you're talking about. And again, this feels very similar. It feels like we've been here before. It just sounds like people are awfully impatient for, there's lots of opportunities to create value. There was lots of technology investing going on in the 1980s. It didn't just suddenly spring forth with the internet in the 1990s, even though the same underlying companies and the servers and the network technology and the memory chips, et cetera, were all linked. It feels like what you're doing, right? Does that feel fair to you?
Yeah, I think it does. I mean, if you everybody wants to compare it to the internet, and so sticking with that for a moment, I think if you think about the internet, there were a couple decades of R&D that happened before it that was mostly relatively quiet. Some academics knew about it, but not that many people did. I think if you draw the comparison here, Bitcoin came out in 2009. I think that's kind of that R&D period. And the reason is, if you think of the ARPANET, it was relatively kind of just relegated to institutions. No actual public people had access to it. And for Bitcoin, there isn't a whole lot you can do with it. You can send money around, and you can hold it as a store of value. Now, I think those are both huge markets and very powerful, but it doesn't really let you do much in finance itself. And so I think when you see products like Ethereum come out that enable you to use these things called smart contracts, where you can send money to a computer program and remove the lawyers in the middle, then I think that's where we actually started to see this huge flourishing of people starting to build new projects. And so I think that's kind of, maybe it's late 80s, early 90s sort of scenario where you actually see people building stuff on top of it.
So people talk about these dynamics of smart contracts and the idea of removing lawyers, which I'm sure lots of people would like to. Just as a personal aside, I have a letter between General William Tecumseh Sherman and his brother John Sherman, who was the Secretary of the Treasury in the 1870s. And the entire letter is William Sherman bitching about lawyers to John Sherman. So the idea of getting rid of lawyers predates us all. The struggle I have with a lot of these smart contracts, though, is that lawyers play a very valid role in most of the transactions that they're involved with, right? So per discussions about, how do I know what to even put into a smart contract, which will play into a discussion of Augur as we move forward. Lawyers play an incredibly important role there. It's not just, filling out traditional forms, et cetera, right? What strikes me as most interesting about the potential for smart contracts is introducing legal contracts in areas where we've dispensed with them because of the cost. Right? I was talking with John Burbank earlier about, magazine subscriptions. Right? You used to receive again, you're too young to remember this, but you used to receive a mailer and you'd fill it out. And that was a legal contract, right? That said, I will pay $17 a year for 12 issues of, Newsweek magazine. And we dispensed with that because the cost of actually enforcing somebody's viewing Newsweek magazine when it moved digital was just too high, right? But the potential for smart contracts to reintroduce that type of exchange so that I can get rid of the much hated universal advertising type vehicle. That's really how you guys are thinking about things like smart contracts. It's not getting rid of lawyers on an M&A for a $50 billion transaction.
Yeah, I agree. I mean, I think you're not going to get rid of lawyers in general. They're still going to be around, still be very relevant. In fact,
do you have any technology that can do that? No, I'm joking.
That'd be the dream, right? But I think, and they're even going to be relevant towards helping write better smart contracts as well. I think if you fast forward the future of the legal profession 10, 20 years in the future, we'll see a lot more lawyers who have CS degrees. I think it's going to be very relevant to this sort of stuff. I think the main benefits of smart contracts, though, are once you have a solid contract written and it's open source, there's no need to involve a lawyer after that point for that given contract. And they also make it really easy to do things in a very generalizable way. So you can create a system that allows people to create things like new financial markets in a very systematic way, where you don't need a lawyer to customize every single aspect of it.
So let's jump in that direction, because I'd mentioned earlier you had founded Augur, and you told me before this interview that that's about to go live.
Yeah, that's right, July 9th.
So this is one of the very first, if not the first ICO, is that correct?
The first one on Ethereum.
The very first one on Ethereum. And you go live in July. And so what is that going to mean? What will that practically mean?
Yeah, so what that practically means is right now Augur's running on a test network version of Ethereum with fake Ether and fake money. And in July, it'll be on the main network version with real money, essentially.
When you say it's going to be running with real money, right?
Cryptocurrency,
first of all. So I will need to buy some Ethereum in order to transact on Augur. And what can I actually do on Augur?
Yeah, so there's basically three things you do, but I think 99% of users will do one of two. And those two things are, one is you can trade in a financial market on Augur. So the way it's set up is there's actually a built-in community-curated category system or you can also just search for whatever you want to trade on. And then the second piece is, if there's not a market for what you want to trade on, you can actually create a market for that, which I think is actually the most powerful piece. Because up until this point, that's not really been feasible. Like if I wanted to create a market on, the price of a pound of onions rolling every month, that's just not possible today. In the United States, it's actually illegal. In the UK, it's tons of startup costs to get it off the ground.
So that's actually a really great example. Not the onions, but the cost. I'm sure the onion market will be a runaway success. But we're all familiar. Anybody watching this has probably watched the movie The Big Short, right? And there's a classic example of this type of dynamic. I encounter this all the time because I deal with OTC swaps, or I deal with OTC options, over-the-counter options, which are customized contracts, right? So I approach Goldman Sachs, or Goldman Sachs approaches me with somebody who has made a bet in the opposite direction, right? The price of onions are going to be greater than $5, but these markets are expensive to set up. They require Goldman Sachs trained PhDs. They require the Goldman Sachs pound of flesh, and they tend to be very illiquid, and the observation is often somewhat difficult, requiring tons of legal interventions and language that runs several pages. But this is effectively what the character that was the individual played by Christian Bale was doing in that scene in the movie where he says, I'd like to create an option. I'm going to have a bank create an option for me on home prices. And so this takes that and democratizes it as an overused expression, but it radically lowers the cost.
Yep.
How do you see this launching? I mean, is this instantly going to take the world by storm and replace OTC options, or?
Not in the beginning. So I think the way to think about it is, there's actually a good reason why it shouldn't grow fast, but I'll address that in a second. So the first thing is, on Ethereum, you can only do about 10 transactions or so per second. So in the beginning, it's primarily going to be used for things that I think where you're not super actively trading. So maybe some of these sorts of swap agreements where you do an agreement once and then a month later it resolves, or maybe like betting on a sports match or an election or something. But you're not going to be trading, say, a derivative on Apple in the beginning, just because of the fact that people who trade derivatives on Apple want to be able to trade pretty quickly. Over time, as Ethereum scales, that will change. The other reason it's good that it hopefully won't grow super fast in the beginning is, since this code is all open source, it's very likely that it actually has security vulnerabilities in it. So it's good that if the system gets hacked, it gets done in the beginning when there's relatively little capital in the system, so that we can work out those kinks and problems. Even Bitcoin, had a big vulnerability in 2010 where somebody created, I think it was like quadrillions of extra Bitcoin, and they had to, roll it back. And so I think it's important that it grows slowly in the beginning.
Fascinating. I mean, that's tremendous awareness of the challenges that can be created there. And it is one of the advantages, right? So, I mean, Dan was referring earlier to the aspect in solving a criminal case, right? But that ability to rewind the world, and go back to the point at which a violation occurred and correct it, is a somewhat unique feature of cryptocurrency. So forensic accounting does, but blockchain and other technologies associated with it effectively, again, democratize that or radically lower the cost of that type of forensic accounting.
Yeah, no, blockchain, in one of its many attributes, is an immutable paper trail of every transaction that's ever happened. So
It's not
there's
paper,
a lot of
but it's...
there's a lot of cool things that you can get out of that.
So Joey is overseeing a fund, and how actively involved are you in the Augur launch at this stage?
Mostly just kind of overseeing the future direction and vision of the project. I don't actually, write code for it anymore. We have a team of about 20 people who works on it.
And so what other projects like Augur do you think we can be looking for over the course of the next couple of months that should change the way, or begin to change the way people start to think about this use case dynamic?
I think Joey's best equipped to.
Sure. So I think another big one is, for these sorts of financial applications on Ethereum, you don't necessarily want to use Ether as the underlying currency because it's very volatile. So one really important application that's actually went live a few months ago is a project called Maker, which is a collateral-backed cryptocurrency that aims to be stable relative to the US dollar. Actually, it's relative to the special drawing rights of the IMF, but practically speaking, that's basically the dollar. And I think that'll be really powerful because then every other project on Ethereum can all of a sudden use this asset that's basically very stable, very low volatility to back their underlying contracts. Besides that, I think we'll see some stuff that's just very practical and kind of fun use cases. So in the beginning of the internet, you saw a lot of people create gambling sites. Same thing is going to happen here. There's a project we invested into called Funfair, which is an online casino on Ethereum. There's also one called Virtue Poker, which is decentralized poker on Ethereum. And those are both kind of really low-hanging fruit, cool use cases where today you have a few problems. One is you have to trust the online poker site not to cheat, not to deal the hand in a malicious way. On the online casinos that are just straight up gambling, you have to trust that they're actually telling you the odds honestly. They're not screwing you over. Like in a regular casino, they have a payout ratio and they get audited and stuff like that. Online, that doesn't really happen. So they could say their payout ratio is whatever, and they could be completely lying about it. Versus if it's all open source on the blockchain, you can easily prove whether they're being honest, and the fees are also much lower. Those aren't the most revolutionary things in the world, but I think that's the sort of stuff we're going to start to see come out first.
No, but it's actually a really interesting point, right? Because we have a Nevada licensing committee, for example, that controls and monitors, the same thing, New Jersey, right? That you require a large infrastructure in order to maintain, the regulatory environment around this. And suddenly you're talking about evaporating that and turning it into, a piece of smart contract for all intents and purposes, right? How do you think about the regulatory apparatus reacting to that, right? Because there's nothing that prevents us from putting one-armed bandits on the same dynamic and wiping out the need for very well-paying jobs in the Nevada regulatory environment.
Well, I guess the important point is peer-to-peer gambling's always been decriminalized. So if you're having a poker game in your living room, the cops can't kick the door in and arrest you. And smart contracts allow you to do peer-to-peer gaming without having a central counterparty, and that's basically it. I think Funfair, a project like this are a great example of how simple smart contracts actually are, because all the stuff about smart contracts, and it sounds very high tech, but it's basically telling the computer, here's $10 worth of cryptocurrency. If the roulette wheel stops on 00, you pay this guy. If it doesn't stop on 00, you pay the other guy. And that's how simple smart contracts can be.
So that's a wonderful articulation of it. There is this element of, if I get cheated by a casino, right? There's two ways that I can play this, right? One is I can seek restitution, right? And the second is I can make sure that they're put out of business, right? From a reputational standpoint, that's very easy to do in the blockchain world, right? Just basically raise a flag, say these guys are criminal operators or unfair operators, and that's been proven, and it becomes extraordinarily tough for them to get back into business again, right? But how do you go about capturing restitution, right? I mean, that's where the lawyers come back in. That's the traditional court system, et cetera. How do you think about that development and that dynamic? Who turns into the policeman and the court system in the blockchain and crypto world?
Yes, I think one thing is it depends on, first of all, it depends on whether you actually have an operator or not. Due to the fact that smart contracts are run on a bunch of computers around the globe, a lot of these applications don't actually have a central operator that's really controlling anything. So at that point, the kind of who do you get restitution argument from becomes very different. You could say, we could sue the developer who wrote it, but I don't think that quite makes sense. It's kind of like suing the author of a book because you had a really bad thought after you got to a certain chapter. It kind of goes against free speech in a sense. Code definitely has been protected as under free speech by the Supreme Court in the past. So I think the other dynamic at play too is these systems are very global. If you think of a regular casino, it's generally relegated to a specific location, whether that's Nevada, Atlantic City, or whether it's they're usually physical locations. All the online ones are usually one country, so it's very easy to kind of figure out what court system any sort of problem falls under. In these blockchain-based systems, it's kind of like, well, who has jurisdiction over, say, Ethereum? I think there's kind of two possible answers to that, right? There's what regulators may think the answer is, and then there's the second answer, which is what, practically speaking, who actually does. I think in the practical standpoint, right now, it's really the community of developers, miners, people who are using it and building on top of it. a practical example for what happened in a scenario like this is when the Dow smart contract in 2016 got hacked, a bunch of people lost their money, and the network basically voted. They voted on whether to roll back that transaction and basically hard fork to a universe where that person didn't steal all the money, or voted to let it continue, and they voted to actually roll it back. That's interesting for a couple of reasons. One is because they're actually able to make an effective governance decision in a relatively short period of time without getting a bunch of regulators involved or a huge long court process. On the flip side, if you look at the Mt. Gox case, no one has gotten their money back still, and they actually have more than enough money to pay all the original deposits. And so it's kind of an interesting comparison between the old existing legal system and kind of how fast you can move on the tech side. It's not to say there's not downsides, but it's pretty interesting, I think.
Yeah, and the important point is there's provably fair gambling odds. So if it ever diverged from that, people would just stop using that site and they'd go to one that was provably fair. So it's not like finding out, the casino's been ripping people off for 12 years and there's an enormous amount of back restitution we have to make. In the unlikely event that a online crypto casino is doing something wrong, people notice it quickly and Darwinism go somewhere else.
Well, the other dynamic, though, that creates, right, is you would expect to see systems very rapidly converge. So casinos, as you mentioned, would be low-hanging fruit, right? So people would very rapidly converge to a fair system, right? Online poker would potentially, it would be very difficult, for example, for an Indian casino in Central California to justify why their video poker machines are not linked to the blockchain, right? How do you think about that type of disruption? And again, to your point, how regulators choose to react to it?
Yeah, so your point is kind of like people will start demanding to see the same level of accountability for regular casinos. Yeah, I think that's something that will happen. I think, since they're kind of larger institutions, and generally like the slot machines aren't upgraded super frequently in casinos. If you walk around in Vegas, they tend to look pretty old. But I think people will start demanding it, and over time, I think we will start to see more transparency from them. I don't think there's really much of a downside from anybody's perspective, because from the regulator, the enhanced transparency makes basically their job a lot easier. From the user, the better they actually know what's going on. In the casino, if you do it in a smart way, it shouldn't require them to do much extra.
What I would expect to see in that sort of scenario is people start to vote with their feet, right? That ultimately the odds are better in the online casinos, and people would attend the Indian casinos less, and they would either have to choose to shut or to make the investments to move themselves onto the blockchain. But that is going to take time, and it does feel that there will be a regulatory pushback in potentially a variety of areas. I mean, how do you guys think about that? When does the reaction happen, right? I mean, because that's been one of the big questions, is when are the authorities going to step in and prevent the rise of alternatives to fiat currencies, which allow them to collect taxes or various other things?
Well, Mike, I think your analog's spot on. People will vote with their feet because they're going to want more transparency, better service, and a much lower fee. And that's basically what we saw when we started routing voice over IP. We used to have national monopolists that controlled each country. AT&T used to be 16% of the market cap of the entire United States. And now nobody even thinks about the cost of connectivity to the phone network. And that's basically where you're going to see gambling, or the other 25 interesting use cases that crypto is. The cost for consumers is going to go way down and the quality is going to go way up.
It's a great analogy, and it's one that I love because it takes me in the next direction, which is, where do you guys see huge investments that are being made similar to the AT&T analogy? And really, AT&T established a price umbrella under which companies like Global Crossing or WorldCom had its own issues, but created a price umbrella under which an incredible amount of investments, level 3 would be a good example, where people made huge investments in infrastructure, in physical construction, et cetera, that ultimately failed to deliver on the underlying promise. And this is particularly a problem in the debt markets, because the prices were so deflationary and they just collapsed. Right? Do you guys see areas where people aren't making those assumptions today? That is a negative case for for where you see investment occurring?
Oh, I'd say that I don't see it as a negative case, but all the payments monopolies and oligopolies have very high rents, and there's a lot of blockchain-oriented solutions that will undercut them.
Yeah, I think maybe one area kind of, and this is kind of a categorical statement, but I think if you look at just businesses in general, they're not focused enough on kind of migrating to certain technologies, particularly blockchain tech, that can drop their cost of operation down a lot. Instead, they're just kind of focused on staying in the same place, operating with very high operating costs. Two good examples of this are like MoneyGram and Western Union. You look at them and you actually look at their balance sheet and their profit and loss statement. They're actually not that rent seeking in the sense that it's just actually really expensive for them to operate because they're so dang inefficient. And so if you're a company like that, instead of just continuing to funnel billions of dollars in cash into your operating expenditures without trying to make any part of your process more efficient, you should try to make it more efficient, undercut your competitors, and increase your margins all at the same time. I think it is possible for a company like that to do that. In practice, I think it won't happen and they'll get displaced. But I think that's probably the biggest mistake I see in general.
Well, so MoneyGram would be an interesting example, right? Because the stock's down 92% or something from its peak. It's gone from being a $16 billion company to a $700 million company, I think. That would very clearly be one. But if you think the Visas of the world, which are networks that control significant rent-seeking dynamics in terms of payment processing, very efficient in terms of a number of transactions relative to an Ethereum or certainly to a Bitcoin, and operating at a low cost, perhaps not as low as we can get in a crypto world, certainly efficient and showing that as a 60+% profit margin, right? I mean, really, really attractive businesses. If those are going to give way, that's going to have a meaningful impact on how people think about this space. Is that something that you see happening within an investable time horizon, or is this just a headwind that those industries are going to, those platform companies are going to face?
I think on that one, that specific use case, I think it is kind of more of a headwind. It's really hard to invest in that specific use case right now because it's so early. But I do agree that it's also one of the most impactful, but it's probably going to happen towards the end of the list of stuff. And I think if you look at the impacts of it, 2 to 3% for Visa, MasterCard looks small on paper. But if you're, say, a retail business or a small business in the United States, your margins are typically 3 to 5% anyway. So you can almost double your margins if you can cut that fee or cut that middleman out. And so I think over time, we'll start to see more and more of that. Visa and MasterCard are interesting because they actually would benefit even using blockchain internally because they pay so much to the banks that they work with. They actually don't take very much of the fee for themselves. A lot of it goes to the banks. So you could get credit card fees, in my opinion, down to like 0.5% if they just switch to using an underlying blockchain alone. Whether it goes lower than that, if everyone switches away from them or not, I don't know. 0.5% may be low enough people are okay with it. I think that's something that those companies will migrate to and do eventually. It just makes logical sense, in my opinion.
And so what do you think is holding them back from making that change now? Because if they could get to 0.5%, obviously it'd be foolish not to do so. There is an element, as you're saying, this is one of the first situations where we're readdressing a very popular 90s phrase, the innovator's dilemma, right? Where them making that transition would actually be bad for their prior partners, the banks, might help forestall some of the inroads of a blockchain and a crypto-based solution, right? A peer-to-peer based solution. What do you think is keeping them from doing that?
Yes, I think they've announced they're working on stuff internally. I think the question is, why is it not in production? I think the reason for that is, if you think about it, what they would have to do to credibly kind of take the banks away would be to have something that's very, very trusted. And even though people trust Visa and MasterCard, I don't actually think that they trust them enough to allow them to operate, say, a private blockchain where they process all these transactions. And I think the banks would just be so mad they would quit working with them. And so I think that for this to actually work, they probably would have to do something that was generally public, open to people to see, and be able to audit it. And so I think in that scenario, the scalability problems haven't been solved yet. I think once you get to that point, you can kind of try to credibly tell the banks to go away, because if you're Visa and MasterCard, you can say, hey, look, this is publicly auditable. Like, we don't need you to oversee us anymore. We have this public ledger that anyone can view. Versus if they said, hey, we're going to do it all in-house, then Visa and MasterCard kind of lose the argument of, hey, we had this huge consortium of banks that audit us and make sure we're being honest.
And I think Visa has been pretty forward-thinking, given their legacy business. They have a deal with one of our portfolio companies, Chain.com, to build a private blockchain prototype. But these things do take a decade, right? The hugely important financial systems don't change overnight.
Well, one of the dynamics that people often talk about within disruption, right, is that it's nowhere near as exciting to work for Visa as it is to work for a startup, right? And the best talent tends to converge on the opportunities and the innovation as compared to working for the large institution. Is that a risk for the existing institutions in your mind, or am I overblowing that dynamic?
You have to whisper. They're just downstairs. It's their headquarters. No, I think they're all evaluating when is it time to bring the fee structure down that hasn't changed in 50 years and has a 60% operating margin, versus when will the outsiders make headway. And I agree with Joey that retail processing is one of the absolute last things that blockchain will do. There's massive network effects. Visa, MasterCard do their job really, really well. And so we haven't invested in any credit card processing type competitors in the companies we've invested in over 6 years. And I think, that will be one of the very last things that gets disrupted.
So we talked about the prediction markets and things that effectively could replace many markets like OTC swaps, et cetera, and options markets. And I mean, again, just like reiterate, when you have something like Augur, there will be companies, I would imagine, that will become participants that might have a particular need because of an expiring contract on a legacy basis to have a particular option that expires on 11/35 on the level of the S&P on Thursday, June 17th, 2023, right? Which is something that I can go to Goldman Sachs and have them create for me today. But it's not something that's easily available in an exchange-traded basis, right? So I am involving a lot of lawyers. I'm involving a lot of resources. I have to have an ISDA agreement. There's, tremendous costs in setting something like that up. And so I would expect there to be use cases like that to begin to emerge relatively soon on a platform like Augur. Where else should we be looking for early disruption? Where have you guys identified areas that you think are particularly important?
Yeah, I think we will actually see some stuff in payments. Ignore the Visa, MasterCard stuff, not disrupting them at this point, but more like there's a lot of businesses that actually can't accept credit cards. They can't process them, and they're just forced to accept cash today, or they're forced to do these things where you relay the money through like a Cayman Island company, and they charge you 10 to 15% in credit card processing fees. This can be anything from a gambling business to things that are much more considered legitimate, respected businesses like airlines. If you start up a new airline, you actually can't process credit cards. If you're American Airlines, you can basically bully Visa into letting you use their network. But if you're a startup one, it's actually very difficult. Most of the card networks actually ban them. And so there's a huge swath of these businesses that can't process payments today. I think that's one area where we actually will see the tech start to be adopted in the short to midterm.
Just very quickly, so is not knowing the particular dynamics behind that, is that effectively just a bad actor dynamic because the Visa network through its member banks bears the cost of fraudulent activity? So somebody that collected large cash payments in exchange for services to be rendered in the future, that would be an area that would have high risk of fraud, or?
Yeah, exactly. So it's anything that has high fraud risk, which to Visa and MasterCard is basically greater than 4 or 5%. And the cool part about crypto is if you're paying up front and it's crypto and you can't reverse it, the fraud risk basically doesn't really exist.
Well, you can reverse it, you're saying. So like you could say that wasn't a legitimate transaction, they failed to deliver the service.
Well, you can still have like traditional dispute mechanisms and stuff, just like you have in a regular business model, but it's different in the sense that like someone can't arbitrarily charge you back. So like, for instance, say I booked a flight on this new airline and I was unhappy with it, I'd have to go through customer support or something to get my money back if I paid in crypto. Versus in the Visa MasterCard scenario, you can just do a chargeback and that cost trickles through the system and causes them to pay more.
So you're saying from the business operations standpoint, right? I would then have to dispute that with the member banks and with Visa. That would incur costs that would ultimately impact my bottom line.
Yep, and if you have too many disputes, they'll actually just shut you off, which is kind of, then you're kind of out of luck and are just forced to accept cash.
Okay, so early in the payments, effectively addressing the bad actor dynamic, and anything else that you guys
One
think of?
use case is cross-border money movement. Almost all countries, a domestic electronic payment is pretty much free and pretty much real time. But whenever you cross a border, it gets really slow and really expensive. Even from, say, the US to the UK, two very sophisticated countries, costs $45 to do a wire. You have no idea how many British pounds are going to pop out the other end. There's 4 or 5 banks that take a little bite out of your trade as it's moving. And with blockchain, particularly Bitcoin, you can do cross-border money movement that's within tens of minutes, and you know exactly how much money is going to pop out the other end. You get a mid-market FX rate, and you normally pay, say, 1.5% fee rather than several percent.
So if you were a public investor, if you were sitting in my seat or you were sitting in a retail investor's seat, how would you choose to invest in this space?
Put it all on overstock.com.
All on overstock.com?
No, I'm just kidding. I don't really think there is a public markets trade right now. All the blockchain-enabled companies are still private, so there isn't yet a big public strategy.
Again, that analogy feels correct to me, that we're earlier in this process than most people think. We're nowhere close to the Netscape IPO. Do you think that?
Yeah, but one thing to put perspective on it is there's 30 protocols that are unicorn-sized, right? So there's a lot of big investable things. They're just not listed on the New York Stock Exchange.
Do you see regulation changing in that way? We talked a little bit about Augur being an early ICO on the Ethereum platform. Do you think ICOs are coming to the public markets, or to the equivalent of the public markets, where they will be accepted I will be able to deposit it in my Schwab account?
My opinion anyway is probably not. I think we probably will see sorts of things where like you can buy into an ICO on an alternative transaction facility or something, but I don't think we'll see them on like NYSE or NASDAQ, at least not anytime soon. Just because I think they're such weird assets, they're kind of so idiosyncratic and they're all very different and so unique that it's really hard to kind of categorize them in any sort of box. I think the best any sort of regulatory body has done so far is the FINMA regulators in Switzerland have kind of come up with 3 categories. They've come up with equity, currencies, and then things that are what they consider to be utility tokens, which is kind of neither of those. I think that's a decent approach, but even there, they're not trading on the public markets. They're kind of each ICO is different and unique. Fast forward a decade, maybe that changes, but I think for the next foreseeable few years, it's probably going to be each on its own.
So when you encounter somebody who's a passionate Bitcoin fanatic, how do you think about that? Is that just somebody who's made money in the past and has now created an argument that they'll make money in the future, or is that is there something there that the rest of us are missing?
I think this is a new asset class, and in 10 years, every institutional investor will have a blockchain team, they'll have a blockchain asset allocation, and we're just kind of in that interregnum period between early adopters and very institutional investors.
And so to use the internet analogy on that, right? Today everybody has a technology team. Today everybody has a technology allocation, but nobody has shares in globe.com. If you were to think about the vehicles that are out there today, Ethereum certainly sounds like one that you're very interested in, certainly within the context of Maker having created a stable reference point. Would you be surprised if Bitcoin went to 0 over the next 5 years?
I'd be extremely surprised if a basket of cryptocurrencies was not worth a lot of money in 5 or 10 years. Bitcoin versus Bitcoin Cash versus Ethereum, there's lots of arguments on all different parameters, and any one of those could potentially go to 0, but as a whole, if you have a half a dozen of them, it's very unlikely. And that's very different. 5 years ago, I used to tell people, you could lose it all, because crypto could be a dumb idea, the G7 could outlaw it, something really bad could happen. Given that there's been a crypto application #1 on the App Store in Apple, and 60 million people have it, I think it's reached escape velocity, so it's probably not going to 0. but any individual one could theoretically.
Would you?
Yeah, I'd say I'd be very surprised if Bitcoin itself went to zero over the next 5 years. What I'd not be surprised about, though, is if Bitcoin, as a percentage of the overall cryptocurrency market cap, continued to lose market share over the next 5 years.
And you mentioned G7 outlawing it. Are there any regions around the world where you're particularly concerned about the legal framework or the legal outlook for crypto?
I'd say that 95% of the countries are totally neutral. They don't do anything to help crypto, and they don't do anything to hurt it. There's a few countries, like Luxembourg, they're very progressive in promoting crypto. And then there's a few countries like China that have national policies that might have their own self-interest at stake. But 95% of the countries don't really care either way.
And so I mentioned China early on. You brought it up. How do you think about China and Bitcoin, right? Because if I understand correctly, roughly 70% of the hashing is currently done, and mining is currently being done in China for Bitcoin. Is that, and any statistics that I say wrong, please correct me on that. But how do you reconcile that, right? Because China has been one of the most restrictive, and yet paradoxically, it has one of the most active, at least traditional crypto space environments.
Yeah, I think the earlier comment was, on electricity consumption, and there might be pockets of China where electricity is near zero cost, and that subsidizes mining, and then the demand for cryptocurrency saving vehicles is very strong in countries like China that have potentially weak banking systems, and the citizens want to save. China's been one of the largest importers of gold for decades because the citizens want to save in something other than the banking system, and that might be one of their rationales. But I don't put myself out as an expert on Chinese policy.
Joey, if I were to think about what's the coolest new technology that you've seen emerge in this space in the past 6 months, what would be your pick?
Yeah, so mine would be this project called Celer. To make sure people understand, it's Celer, C-E-L-E-R. It's not Stellar. It's a project that they came to us a few months ago, and it's a team of about 5 PhDs and people who also worked at Google and YouTube. And what they're working on is a scalability solution for blockchain tech. So we talked about in this conversation how most of this stuff only does 10 transactions per second. There's been this idea that's been kind of circulating around the past 3 or 4 years called payment channels, or alternatively called state channels. And it's a really neat idea for doing lots of transactions off-chain and then settling on-chain once in a while. The problem with it, though, is that when you're sending payments around, you have to route these payments through a network. And up until now, it's been an unsolved computer science problem of how to do that. So the best solutions today typically require about 10x the collateral you would need to do a simple, it's like a $5 payment requires $50 in collateral locked up. That's not going to work. These guys have come up with an optimal solution, like theoretically optimal. You can prove it with mathematical proofs. That they've come up with a solution to this problem. So it's the most exciting thing I've seen in the past 6 months, because it actually gives me quite a bit of confidence that we will see those transaction throughput numbers increase. Versus if you asked me about that question 2 years ago, I would have been much more bearish on the space scaling.
Fantastic. We did this roughly a year ago. I'd love to do it again. You guys willing to sit back down in 6 months to a year and catch up on what's new in the crypto space, what's going on in Pantera? And I'd love to follow up in particular on how Augur is developing. Maybe we can talk through some of that in detail as we talk next time.
Cool.
Thanks,
Guys,
Mike.
thank you very much.
Thanks.
Thanks.
Dan and Joey gave us some really fascinating insights in terms of the cryptocurrency space. In particular, we get to look forward to the Augur launch in July. That's going to be one of the exciting first ICOs on the Ethereum space that goes live. Can't wait to see how that develops. I'm also really interested in Dan's general thought that the cryptocurrency space is developing, that the probability of the overall space turning out to be a disappointment is very low. And it's really interesting to hear how that thinking has developed over the last couple of years. I look forward to catching up with them again in 6 months to a year to find out what new is happening and what their thoughts are then.